Cryptocurrency markets are driven by psychology more than technology, and understanding market psychology is the difference between consistent profits and emotional losses. While 95% of crypto investors make predictable psychological mistakes, buying tops during euphoria and selling bottoms during panic, professional investors use systematic approaches to recognize and profit from these behavioral patterns. In this comprehensive guide, I'll teach you the psychology behind crypto market movements, how emotions drive price action, and most importantly, how to overcome your own psychological biases to make better investment decisions. Before diving into crypto specific psychology, let's understand the fundamental psychological forces that drive all financial markets. Why psychology dominates markets? Financial markets are ultimately driven by human behavior. Collective emotions. Markets reflect the collective emotions of millions of participants. Fear and greed cycles. These primary emotions create predictable market patterns. Herding behavior. Humans naturally follow the crowd, especially during uncertainty. Cognitive biases. Systematic errors in thinking affect all market participants. Information processing. How humans process and react to information drives price movements. The efficient market hypothesis versus reality. Traditional finance theory versus behavioral reality. EMH theory. Markets are rational and prices reflect all available information. Behavioral reality, markets are driven by emotions, biases, and psychological factors. Market anomalies, predictable patterns that exist due to human psychology. Crypto amplification. Cryptocurrency markets amplify psychological effects due to higher volatility. Core psychological market drivers, fear, loss aversion. The most powerful emotion in financial markets. Definition. Fear of losing money is psychologically more powerful than desire for gains. Market impact. Fear creates selling pressure and market crashes. Amplification. Social media and news amplify fear during market stress. Opportunity. Extreme fear often creates the best buying opportunities. Greed, FOMO, fear of missing out. The driving force behind market bubbles. Definition. Desire for profits and fear of missing opportunities. Market impact. Greed drives buying frenzies and bubble formation. Social proof. Seeing others profit intensifies FOMO danger. Greed leads to buying at market tops and excessive risk taking. Hope and denial, psychological states that prevent rational decision making. False hope, believing. Losing investments will recover without evidence. Denial. Refusing to acknowledge when investment thesis has failed. Anchoring, holding on to initial price points that no longer matter. Sunk cost fallacy. Continuing bad investments because of past losses. Market psychology cycles. Understanding the emotional progression of market cycles. Optimism. Early recovery, cautious optimism. Excitement, growing confidence, increasing participation. Euphoria, maximum optimism. Everyone is investing. Anxiety, first signs of trouble. Doubt creeping in. Denial, refusing to acknowledge problems. Panic. Fear dominates, mass selling. Capitulation, complete surrender, maximum pessimism. Depression, despair, market considered dead. Hope, first signs of recovery, cycle begins again. Cryptocurrency markets have unique psychological characteristics that amplify traditional market psychology. Crypto psychology amplifiers 24/7 markets. Continuous trading creates unique psychological pressures. Constant monitoring, no market close means constant price awareness. Sleep disruption. Market anxiety affects sleep and decision making quality. Global fear, greed. Emotions compound across time zones. FOMO amplification. Fear of missing moves during sleep or work. Extreme volatility, high volatility amplifies emotional responses. Dramatic gains or losses. 50-90% moves create intense emotional reactions. Leverage effects. Borrowed money amplifies psychological pressure. Portfolio concentration. High crypto allocation increases emotional investment. Social media amplification. Extreme moves generate more social media. Discussion. Technology. Complexity. Technical complexity creates unique psychological factors. Knowledge gaps. Not understanding technology creates anxiety and poor decisions. Imposter syndrome. Feeling inadequate compared to technical experts. Analysis. Paralysis. Too much technical information preventing decisions. Overconfidence. Small technical knowledge leading to excessive confidence. Community and social factors. Crypto communities amplify psychological biases. Echo chambers. Reinforcement of existing beliefs within communities. Tribal behavior, loyalty to specific cryptocurrencies over rational analysis. Influencer impact, social media personalities affecting mass psychology, narrative warfare, competing stories affecting market sentiment, unique crypto psychological patterns, the hodl mentality. Psychological pattern unique to crypto origin. Hold on for dear life during market downturns. Psychology. Combining loss aversion with long term optimism. Benefits. Prevents panic selling during normal volatility risks. May prevent rational exit strategies or rebalancing altcoin season psychology. Predictable psychological rotation in crypto markets. Phase 1. Bitcoin leads market recovery. Phase 2. Ethereum and large caps follow. Phase 3. Small altcoins pump dramatically. Phase 4. Rotation back to safer assets. Psychology. FOMO drives investors down risk curve seeking higher returns. ICO new project FOMO. Psychological pattern around new cryptocurrency launches. Discovery phase. Early adopters find new projects. FOMO phase. Social proof creates buying pressure distribution. Phase. Early adopters sell to new entrants. Reality. Phase. Projects judged on actual utility and adoption. Understanding and recognizing cognitive biases is essential for making rational crypto investment decisions. Major cognitive biases affecting crypto investors. Confirmation bias, seeking information that confirms existing beliefs. Definition: tendency to search for and interpret information that confirms preconceptions. Crypto. Example: only reading news that supports held cryptocurrencies. Market impact creates echo chambers and prevents objective analysis. Solutions: actively seek disconfirming evidence and diverse viewpoints. Anchoring bias, over relying on first piece of information received. Definition: heavy reliance on first information, anchor, when making decisions. Crypto example: fixating on cryptocurrency's all-time high price. Market impact prevents adjusting expectations based on new information. Solutions: regularly reassess investment thesis with current information availability. Heuristic: overestimating likelihood of events with greater media coverage. Definition: judging probability by how easily examples come to mind. Crypto example: overestimating hack risk after seeing news coverage. Market impact: media coverage creates disproportionate fear or optimism. Solutions: use statistical analysis rather than memorable examples. Overconfidence bias, overestimating one's knowledge, abilities, or chances of success. Definition: excessive confidence in one's judgment and abilities. Crypto example: believing ability to time markets after early success. Market impact leads to excessive risk taking and poor diversification. Solutions: track prediction accuracy and maintain humility. Loss aversion and endowment effect. Psychological attachment to owned assets and fear of losses. Definition: feeling losses more acutely than equivalent gains. Crypto example: refusing to sell, losing cryptocurrencies. Market impact creates artificial support levels and prevents rebalancing. Solutions: focus on forward-looking analysis rather than past performance. Herding and social proof, following the actions of others rather than independent analysis. Definition: tendency to follow actions of larger group. Crypto example: buying cryptocurrencies because everyone else is. Market impact creates bubbles and crashes through mass behavior. Solutions: develop independent analysis framework and contrarian thinking. Recency bias, giving greater weight to recent events. Definition: tendency to weigh recent events more heavily than earlier events. Crypto example: extrapolating recent price trends indefinitely. Market impact creates momentum effects and trend following behavior. Solutions: analyze longer time periods and historical patterns. Sunk cost fallacy, continuing behavior based on previously invested resources. Definition: continuing course of action due to previously invested resources. Crypto example: holding losing cryptocurrency because of amount already invested. Market impact prevents rational portfolio rebalancing and loss cutting. Solutions: make decisions based on future prospects, not past investments. Professional investors use systematic approaches to measure and analyze market psychology. Quantitative sentiment indicators, fear and greed index. Systematic measurement of market emotions, components, volatility, momentum, social media, surveys, dominance, trends. Scale: 0-100 scale from extreme fear to extreme greed. Interpretation: extreme readings often signal contrarian opportunities. Usage: use as one factor in investment timing. Decisions: limitations: can remain at extremes longer than expected. Social media sentiment analysis. Measuring emotions through social platforms. Twitter, sentiment, analysis of cryptocurrency related tweet sentiment, Reddit activity. Measuring discussion volume and emotional tone. Google Trends, search volume for cryptocurrency related terms. News, sentiment, analysis of mainstream media, coverage tone, influencer tracking. Monitoring key opinion leader sentiment changes. Options market indicators, derivatives markets reveal investor expectations. Put call ratios, ratio of bearish to bullish options positions. Implied volatility, market expectations of future price volatility. Skew, difference between put and call. Option prices open interest, total outstanding options positions. On-chain sentiment indicators, blockchain data revealing investor behavior. Hodler behavior, long-term holders accumulating or distributing exchange flows. Net flows into or out of exchanges. Whale activity, large holder accumulation or distribution patterns. Network activity, transaction volume and active address trends. Qualitative sentiment analysis, narrative analysis, understanding dominant market narratives. Emerging narratives, new stories gaining traction in crypto markets. Narrative strength, how compelling and widely believed stories are. Narrative fatigue, when markets stop responding to familiar narratives. Narrative rotation, how dominant stories change over market cycles. Media coverage analysis, systematic analysis of mainstream media, attention. Coverage volume, amount of cryptocurrency coverage in mainstream media coverage. Tone, positive, negative, or neutral coverage analysis. Expert commentary, analysis of expert opinions and predictions. Mainstream adoption, media coverage of institutional adoption. Community analysis, understanding psychological state of crypto communities. Community mood, general optimism or pessimism in crypto communities. Engagement levels, activity levels in forums, social media, and events. New participant flow, rate of new people entering crypto markets. Developer activity, technical development activity and excitement. Systematic approaches. Professional investors use to overcome psychological biases and market emotions. Systematic decision-making frameworks. Pre-commitment strategies. Making decisions when emotions are neutral. Investment rules. Pre-written rules for entry and exit decisions. Portfolio allocation. Predetermined allocation percentages. Rebalancing schedule. Automatic rebalancing based on time or thresholds. Risk management. Preset risk limits and stop-loss levels. Review processes. Scheduled reviews with predetermined criteria. Contrarian investing approaches. Systematic approaches to going against crowd psychology. Sentiment indicators, using extreme sentiment readings as contrarian signals. Value investing, buying when assets are psychologically out of favor. Market timing, using psychological extremes for entry and exit timing. Narrative analysis, investing against prevailing market narratives. Fear greed optimization, buying fear and selling greed systematically. Diversification and risk management, using portfolio structure to overcome psychological biases. Asset diversification, spreading risk across different cryptocurrencies. Time diversification, dollar cost averaging to reduce timing pressure. Strategy, diversification, multiple approaches reducing single strategy risk. Geographical diversification, reducing single jurisdiction risk. Psychological diversification, spreading emotional investment across assets. Psychological training and development, mindfulness and emotional awareness. Developing awareness of psychological states, meditation practice, regular meditation to improve emotional awareness. Journaling, recording emotional states and investment decisions. Body awareness, recognizing physical signs of emotional activation. Stress management, techniques for managing investment-related stress. Professional support, working with professionals on investment psychology. Decision-making protocols, systematic approaches to important investment decisions. Cooling off periods, waiting periods before making major decisions. Multiple perspectives, seeking different viewpoints before deciding devil's advocate. Systematically arguing against your position. Scenario planning, considering multiple possible outcomes. External validation, getting input from trusted advisors or systems. Performance analysis and learning, systematic approaches to improving psychological performance. Decision tracking, recording, rationale behind investment decisions. Outcome analysis, analyzing both successful and unsuccessful decisions. Bias recognition, identifying personal psychological patterns. Continuous learning, regular education about psychology and behavioral finance. Performance attribution, understanding what drives investment performance. Building psychological resilience, long-term perspective development, maintaining perspective during emotional market periods, historical context, understanding market cycles and historical patterns. Goal alignment, connecting investment decisions to long-term goals. Process focus, emphasizing good decision-making process over outcomes. Patience training, developing ability to wait for optimal opportunities. Stress inoculation, gradually building tolerance for market volatility. Professional support systems, building networks that support good psychological decision-making. Investment clubs, groups focused on rational investment analysis, professional advisors, financial professionals who understand behavioral finance, accountability, partners, people who help maintain investment discipline, educational communities, groups focused on learning and improvement, mental health support, professional support for investment related stress, converting psychological understanding into practical investment improvements and systematic approaches. Daily practice implementation, morning market analysis routine, starting each day with psychological awareness. Sentiment check, review current market sentiment indicators. Personal state, assess your emotional state and potential biases. News analysis, analyze news through psychological rather than fundamental lens. Community mood, check sentiment in crypto communities and social media. Contrarian opportunities, look for extreme sentiment creating opportunities. Investment decision framework, systematic approach to all investment decisions. Bias, check. Identify potential cognitive biases affecting decision emotion assessment. Recognize and account for current emotional state. Multiple scenarios, consider best, worst, and most likely outcomes. Risk analysis, assess psychological as well as financial risk. Decision, recording, document reasoning for future analysis and learning. Portfolio review process, regular psychological analysis of portfolio performance. Attribution analysis, understand which decisions were driven by psychology versus analysis. Bias recognition, identify patterns of psychological decision making. Performance impact, measure cost of psychological mistakes. Improvement planning, develop specific plans for psychological improvement. System refinement, adjust systems based on psychological performance analysis. Crisis management protocols, market crash psychology. Systematic approaches during extreme market stress. Emergency procedures, pre planned responses to market crashes. Emotional support, systems for managing stress during market turmoil. Opportunity recognition, framework for identifying opportunities during panic communication. Plan, how to communicate with family advisors during crisis recovery. Planning, systematic approach to portfolio recovery after crashes. FOMO management, systematic approaches to managing fear of missing out. Opportunity evaluation, framework for evaluating new opportunities objectively. Portfolio integration, how new opportunities fit with existing strategy. Risk assessment, understanding psychological versus actual risk of missing out. Patience reinforcement, techniques for maintaining patience during FOMO periods. Alternative analysis, comparing FOMO opportunities to existing holdings. Long-term psychological development. Annual psychology review, comprehensive annual assessment of psychological performance. Decision quality analysis, review year's decisions for psychological patterns. Bias evolution, track changes in personal biases and blind spots. System effectiveness, assess effectiveness of psychological management systems. Professional development, plan for continued psychological education and improvement. Goal alignment, ensure psychological management supports long-term goals. Creating your personalized system for managing market psychology and behavioral biases. Self-assessment and awareness building. Personal bias identification, understanding your unique psychological patterns. Historical analysis, review past investment decisions for psychological patterns. Trigger identification, recognize situations that activate emotional decision making, strengths and weaknesses. Identify psychological strengths and vulnerabilities. Professional assessment, consider professional psychological assessment. Peer feedback, get input from trusted friends or advisors about your patterns. Psychological profile development, creating comprehensive understanding of your investment psychology. Risk tolerance, true psychological risk tolerance versus stated preferences. Decision making, style, how you process information and make decisions. Emotional triggers, specific market conditions that cause emotional responses. Learning style, how you best learn from mistakes and improve performance. Support needs, what types of support and accountability work best for you. System design and implementation. Personal investment rules, creating specific rules addressing your psychological patterns. Entry rules, specific criteria that must be met before making investments. Exit rules, clear triggers for selling or reducing positions. Position sizing, rules preventing excessive concentration due to emotional attachment. Review schedule, regular reviews preventing neglect of portfolio management. Emergency protocols, clear procedures for handling psychological crises. Accountability and support systems, building external support for psychological discipline. Investment journal, systematic recording of decisions and emotional states. Accountability, partner, trusted person who helps maintain investment discipline. Professional support, financial advisor or therapist familiar with investment psychology. Educational commitment, ongoing learning about psychology and behavioral finance. Community involvement, participation in communities focused on rational investing. Continuous improvement process, building systems for ongoing psychological development. Performance tracking, systematic measurement of psychological performance, learning integration. How to incorporate lessons from psychological mistakes. System evolution, regular updates to psychological management systems, professional development, ongoing education and skill building. Long term goals, connecting psychological improvement to investment success. Understanding market psychology is the difference between being controlled by emotions and controlling your investment destiny. While 95% of investors fall victim to predictable psychological patterns, you now have the knowledge and tools to join the 5% who profit from understanding market psychology. Here's how to master crypto market psychology. First, subscribe to this channel for ongoing market psychology analysis, behavioral finance education, and systematic approaches to overcoming investment biases. Second, start implementing psychological awareness in your investment process today. Begin with simple bias recognition and emotional state awareness before making any investment decisions. Finally, share in the comments which psychological bias affects you most. Whether it's FOMO, loss aversion, overconfidence, or something else, let me know your biggest psychological challenge. Remember, the market is ultimately a psychological game. Those who understand and master market psychology have a significant advantage over those who remain victims of their emotions and biases.